Well, hello. My name is Justin Kelly, and I'm the CEO and portfolio manager at Winslow Capital, who is the sub-advisor to New York Life Investment Management's large cap growth products. Over the last 10 years, large cap growth is up nearly 4x, which is an astounding performance record. And that is more than twice the performance of US value stocks or US small cap stocks, and almost four times larger than international stocks. So what has driven this dramatic outperformance? It's simply earnings growth. A lot of market forecasters make a big deal of the valuation starting point, and while certainly it's an input, the primary input to stock performance over time is the compounding of the business or the earnings growth. And the earnings growth of large cap growth has greatly exceeded that of all other styles and markets for the last 10 years. And so the critical question is, will this continue? The answer to that question rests entirely on AI. Is AI a bubble technology? Will the CapEx boom continue? These are the central questions. And so as we look to answer those questions, we look at the adoption of AI technologies thus far. And we can see the companies like JP Morgan, Procter and Gamble, the large US companies are adopting this technology at a very fast rate. And one of the ways that we can see evidence of that is in Anthropic, OpenAI, and Google, the three primary frontier model companies, and what is happening in their business. So to put some meat on this bone, Anthropic was adding $1 billion of revenue per month last year, which was very impressive. But as the technology adoption began to accelerate, they started adding $2 billion and then $3 billion and then $1 billion a week. And now it's $3 billion a week. So their revenue has gone from 9 billion to 45 billion in the first 4 months of the year as this technology has proliferated. And now you're seeing similar trends with OpenAI, with their Codex product, and also with Google, whose cloud computing business is accelerating at an astounding rate. And so when we put all of that together, we conclude that AI is not a bubble technology, and its adoption is only increasing. Now, another way to get at this earnings growth question is to look at the large US tech companies, which make up a substantial percentage of the index. And one of the things we can observe is that the earnings and revenue growth for these companies are accelerating. So if you look at the Meg 8, for example, their revenue growth looks to be growing around 20% plus over the next few years. And those revenue numbers have been being revised higher, which is an indicator of confidence. The earnings growth also looks similar at around 20%. Now, that is very difficult to compete with for value markets, small cap companies, international companies, very difficult to compete with. Another big benefit of large cap growth is not only the large tech platform companies, but a new economic sector that we've coined here at Winslow called data center. And these are companies whose primary business is selling into large AI data centers. And we estimate that this portion of the US large cap growth market will grow to nearly 40% of the index by the end of the summer. And about half of that is in the S&P 500. So this is what has really driven economic growth over the last 3 years. We believe without the AI build out, we would be in a recession. But this is where the earnings growth is for the US economy, and it's primarily a US large cap growth phenomenon. So when we look at the large tech companies, the growth in the data center companies, we could even see faster earnings growth the next 10 years than we have in the last 10 years. That leaves us incredibly bullish on US large cap growth stocks. We also think that companies that are implementing AI technology outside of the tech sector can also be winners as they drive efficiency in their business. And so we're looking for a lot of opportunities in that area. And just to build on that, one of the reasons, if not the primary reason, the US stock market has outperformed the US economy for the last 10 years is because of the margin expansion. We think with the implementation of AI technologies, that is poised to continue. So you can have asset growth in excess of economic growth continuing. So AI is a major catalyst. The evidence suggests that one should be bullish. Large cap growth is the biggest winner of this technology. And in our view, it's still early days. So if investors think they've missed the boat, we think the next 10 years looks incredibly optimistic to us. And the valuation starting point is not dramatic. When we look at the valuations of some of the leading AI companies like NVIDIA and Broadcom, we think it's quite conceivable that just looking out a year or two, the PE multiple could be 10. So I was around during the tech bubble of 1999 here at Winslow Capital, and the PEs were 60. Now they're quite low. So there's some skepticism embedded in those stocks about the sustainability of the data center spending, which we view as healthy. But if it continues, the gravitational pull of the stock should be higher, not lower, given how cheap they are. Similarly, for the Meg 8, just based on consensus numbers, the multiples in the low 20s for next year. That's far from bubble range, particularly given the growth and the positive earnings and revenue revisions these companies have been seeing. So another way to approach whether you've missed it from a valuation perspective is, in our work from a quantitative perspective, the AI stocks are actually becoming less controversial. A way to measure that is the stocks are becoming less volatile to themselves. And the reason we believe that is happening is because everybody can see the adoption of AI technology is accelerating. And that's giving people confidence that this AI build-out will continue for some time. So the evidence suggests one should be bullish on AI. Large cap growth is in the pole position, and our fund is particularly well positioned in the winners of the AI technology over the longer term. There's been quite the disconnect between large cap growth stock performance and the fundamentals over the last 9 months. Basically, the large cap growth market is pretty flat over the last 9 months, while earnings growth has been high teens, low 20s. So if a company can grow its business over 9 months by 15% and the stock price is the same, definitionally it's 15% cheaper. And so that is an attractive setup for many large cap growth stocks where the fundamentals have been very strong and the stocks have marked time. I think the reason that has happened is largely because of the very strong price performance for the few years leading up to this period and some natural skepticism about AI technology. But as the fundamentals have come through spectacularly during the first quarter earnings season, what we're seeing is increased confidence in the outlooks as earnings have been revised higher, and a lot more confidence in the AI sustainability picture as we've observed adoption accelerating. And so we have very attractive valuations, very strong fundamentals, and that's a great combination for the US large growth market.